Another day, another story. Welcome to understanding the concept and nature of financial statements and their analysis. Understanding financial statements is essential for any student or learner who wants to understand the financial health of a business or organization. There are three main financial statements that every concern should know about: the balance sheet, the income statement, and the cash flow statement. The balance sheet shows a snapshot of a company's financial position at a given point in time. It includes information on a company's assets, liabilities, and equity. Assets are what a company owns or has control over, such as cash, inventory, or property. Liabilities are what a company owes to others, such as loans or accounts payable. Equity represents the residual interest in the assets of a company after deducting liabilities. The income statement, on the other hand, shows a company's revenue and expenses over a period of time, usually a year. Revenue is the income generated from the sale of goods or services. Expenses are the costs incurred in running the business, such as salaries, rent, and advertising. The difference of revenue and expenses tell you whether a company is profitable or not. Profit is when revenue is more than expenses. Loss is when revenue is less than expenses. And third is the cash flow statement, which shows how cash flows in and out of a company over a period of time. It tracks the inflow and outflow of cash from operating activities, investing activities, and financing activities. Operating activities include the cash inflows and outflows from day-to-day business operations. Investing activities include the cash inflows and outflows related to buying or selling assets such as property, plant, and equipment. Financing activities include the cash inflows and outflows related to borrowing or repaying loans, issuing or buying back shares, or paying dividends. Analyzing financial statements involves using ratios and other financial metrics to understand a company's financial performance. We use the debt-to-equity ratio to see how much debt a company has compared to its equity. Debt-to-equity ratio is a financial metric used to measure a company's leverage or the degree to which it is financed by debt versus equity. It compares a company's total debt to its total equity. The formula for debt-to-equity ratio is debt-to-equity ratio equals total debt divided by total equity. Total debt includes all of a company's long-term and short-term debt obligations, including loans, bonds, and other forms of debt. Total equity includes all of the funds that have been invested in the company by shareholders or owners, such as common stock, retained earnings, and other equity accounts. A high debt-to-equity ratio indicates that a company has a lot of debt relative to its equity, which can make it more risky for investors or creditors. A low debt-to-equity ratio, on the other hand, indicates that a company is less reliant on debt financing and may be seen as less risky. The optimal debt-to-equity ratio varies depending on the industry and the company's stage of development. A more established company may be able to handle a higher level of debt than a startup. Generally, a debt-to-equity ratio of 2 to 1 or less is considered healthy, but it's important to compare a company's debt-to-equity ratio to its peers and industry benchmarks to get a more accurate assessment of its financial health. Other financial metrics include return on equity, which measures how much profit a company generates for every dollar of equity, and the current ratio, which measures a company's ability to pay its short-term debts with its short-term assets. By understanding financial statements and their analysis, students and learners can gain insight into how a company is performing financially. This information can be used to make informed investment decisions, or to assess the financial health of a company when applying for a job or seeking financing. Thanks for watching.